Hi everyone, what's up? Welcome back to my tutorial channel. It's Daniela here and today I'm gonna talk about the cause of financial distress. In this lesson, I'm going to first introduce a couple new definitions and concepts like default and bankruptcy in a perfect market. Then I'm gonna talk about the cause of bankruptcy and financial distress, whether the proposition 1 still holds when the financial distress exists, some trade-off theory, and finally I'm gonna give you a couple of practice. So let's get started with default and bankruptcy. The first concept I want you to get used to is equity and debt. Equity and debt are different fundamentally. Equity holders expect to receive dividends from the firm, but the firm does not have obligation to pay dividends. A firm is legally obligated to make interest and/or principal payments to its debt holders when they become due. The second concept is default. A default is a situation where a firm fails to make full interest or principal payments on its due date. And bankruptcy is a process that the debt holders might have to go through to take legal ownership of a firm after the firm defaults if the default is significant. And here notice that the use of debt, financial, or leverage leads to the risk of bankruptcy, when the use of equity financial does not. To understand this, notice better, we are going to learn deeply in the next few slides. So let's consider this example to understand about debt and equity. Example 1. DSY Inc. is going to launch a new product. If the product is successful, the DSY will be worth $300 million at the end of the year. Otherwise, DSY will be worth only $100 million by the end of the year. Consider the following two capital structures that DSY Inc. may use. The first structure is when DSY use all equity to invest into this project. The second structure is when DSY decide to use both equity and debt with the face value of $150 million that mature at the end of the year. So here we have two different capital structures, and we want to calculate the amount payable to the investors for each of the two capital structures and each of the two possible outcomes. Because for each of these structures, we also have two possible outcomes, whether it's success or fails, right? Alright, so let's consider one by one. Now for the first capital structures, when the investor use all equity, if it's success, if the new product is successful, DSY will have $300 million, and all of these $300 million will go into the equity holders. Of course, there's no debt holders here because the project didn't make use of debt, so there's no debt holder. Debt holder receive nothing. The equity holders will receive $300 million in case of success. Now, otherwise, in case of fail, DSY will have $300 million in return, and all of these $100 million will go into the equity holders because there's no debt in this product. So for the first capital structures, there's no debt holders. The equity holders will receive either $300 million or $100 million in case of success or failure. Now we consider the second case. For equity and debt with a face value of $150 million that mature at the end of the year. So for these capital structures, in case that the product is successful, DSY will receive $300 million, but they have to pay $150 debt. That means equity holders will receive $150 million and debt holders will receive $150 million. In case of failure, if the project is not successful, DSY will receive $100 million, but they owe $150 million debt. So that means all of the $100 million would go to the debt holder, and the equity holder would receive nothing. So this is how we calculate the amount payable to the investor for each of the two capital structures with each of the two possible outcomes. So let's look at this summary table. Here, for the first structure, structure 1, when the investor use of equity, no debt. In case of success, the debt value is 0, equity value 300, and $300 million here will go into the equity holders. And the total value is still 300 because the total firm value is debt plus equity, right? Debt plus equity is the firm value. So the firm value here is $300. Now, in case of failure, DSY will receive $100 million, and all of these $100 million will go into equity value. There's no debt value because the project didn't borrow money to run the project. So debt value is 0, equity value is 100, and the firm value is 100 because the firm value is debt value plus equity value. So that is for the first structure. Now we consider second structure. In case of success, DSY will receive $300 million, but they have to pay $150 debt. So the debt value will be 150 and equity value 150. That means debt holder will receive $150 million and equity holder will receive $150 million. And the total of this, the firm value is 300. In case of failure, the $100 million return will go all into the debt holders, and the equity holder had nothing. And the firm value is 200. So we see here, if we notice here, we see that the firm value here remain the same no matter which structures the investors make use of. You see that? So here the MM proposition 1 holds, right? Remember the MM proposition 1 says that the firm values is unaffected by the structure, the capital structure. So in this example, MM proposition 1 holds because no matter which capital structure we are using, whether we use structure 1 or structure 2, the firm value remains the same. 300 for success and failure is 100. You see that? Now, we are going to consider another situation. Let's look at example 2. Consider example 1 with the following assumption. That means we reconsider example 1, but we have a couple more assumptions. The first assumption, the risk-free interest rate is 4%. The second assumption, the two outcomes are unrelated to the state of economy. That means beta of the project is 0. And the third assumption is the two outcomes are equally likely to occur. That means 50% of success, 50% of fail. This is a fair project. Like we think 50 is like the change to the change of successes and the change of failure are the same. With these three assumptions, we want to recalculate the amount payable to investor for each of the two capital structures and each of the two possible outcomes. So again, we are going to recalculate all of the amount payable to investor under these three new assumptions. So let's consider the first capital structure. For the first capital structure, first, we look at the assumption number 3. The two outcomes are equally likely to occur, so 0.5 is the probability of success and 0.5 is the probability of failure. In case of success, remember, in case of success, the firm value, the firm will receive $300 million. And in case of failure, the firm will receive $100 million. And all of this money would go to equity. There's no debt. So we got 0.5 times 300 plus 0.5 times 100. Because 50% success and 50% failure. And in order to find the value of the firm at this moment, we have to find the present value of this amount. So we basically time 1.04 to the negative 1. This is basics FM, basic financial mathematics. So the value of the firm here is 192.3 million. So this is the first structure, the first capital structure. Now we consider the second capital structure under these three assumptions. In the second capital structures, the firm makes use of both equity and debt. So first, let's consider the value of debt. In case of success, the $300 million received, we will have $150 paid to the debt holder. So the debt value is $150. In case of fail, the whole $100 million that the firm received would go into the debt holders. So that means in case of success, we got $150 million debt values. In case of fail, we got $100 million to the debt holders. And 50% of success, 50% of holder, that means the debt value here is 0.5 times 150 plus 0.5 times 100. And don't forget to take the whole thing times 1.04 to the negative 1 to find the present value. So the value of debt in this second structure should be $120.2 million. Now similar if we consider equity. Equity, in case of success, the firm will receive $300 million, but among these $300 million, they have to pay $150 debt, and the equity holder will receive $150. So that means in case of success, the equity holder will receive $150. In case of failure, the equity holder receive nothing because all of the money that we receive just enough to pay for the debt. And not even enough, is even lower than the debt amount. So the equity holder will receive 0. So the value of equity should be 0.5 times 150 plus 0.5 times 0. And don't forget to take the whole thing times 1.04 to the negative 1 to find the present value. So the value of equity here is 72.1. Now finally, the value of the firm is V is equal to D plus E. We basically sum up the debt and equity values. So the firm value is $192.3 million, and it's the same with the first structure. So in this example, when we have these three assumptions, we see that the firm values remain the same, which is $192.3 million. That means the MM proposition 1 holds. Again, remember the MM proposition 1 says that the firm value is unaffected by the capital structures. So here, no matter what capital structure the investor choose, the firm values will be the same. So the MM proposition 1 holds. See that? Now, let's consider the cause of bankruptcy and financial distress. First, bankruptcy code. In the U.S., bankruptcy is regulated by the U.S. Bankruptcy Code, designed to provide an orderly process for settling a firm's debts. There are two types of bankruptcy: liquidation and reorganization. In this field, we're not gonna focus on the two, liquidation and reorganization. But I just want to introduce there are two types: bankruptcy, liquidation, and reorganization. So what is the cause of bankruptcy and financial distress? Here, when there is bankruptcy or financial distress, there's a couple of costs. There are some different costs go to different professional. It can be either indirect costs or direct costs. So here are some example of direct costs of bankruptcy. When a firm go bankrupt, when a firm bankrupts, there are some costs to hire these professionals: the lawyers, the accountants, appraisers, consultants, the experts in selling distress access. Right, in case of bankruptcy, we have to pay for a couple costs like lawyers, accountants, appraiser, consultants, experts in selling distress access. And there are also some indirect costs of financial distress, like loss of customers, loss of suppliers, loss of employees, loss of receivables, fire sales of assets, inefficient liquidation, costs to creditors. So we see that when bankruptcy and financial distress exists, there can be either direct costs or indirect costs to different institutions and professionals. All right, so our question is whether the MM proposition 1 still holds when there is cause of financial distress or bankruptcy. So the question, does the MM proposition 1 still holds if both risk of bankruptcy and cause of financial distress exists? That's a main interest question. So in order to answer this question, let's consider example 3. In example 3, we are going to reconsider the situation in example 1 and 2, and we are going to have one more assumption. Suppose that the cost of distress is $50 million. Calculate the firm value for each of the two capital structures. So let's relook at the whole thing here. But before we begin, I want you to keep in mind that the cost of distress only have impact on debt values. So here we consider two structures. In the first structures, when we use all equity, remember the cost of distress only have impact on debt values. So in the first structure where there's no debt value, the value of the firm will remain the same. In case of success, we have $300 million go to the equity holder. In case of fail, we got $100 million go to the equity holder with the change of 50%, 50%. So the value of the firm is 0.5 times 300 plus 0.5 times 100, then the whole thing times 1.04 to the negative 1, which is $192.3 million. This is the firm value for the first structure. Now for the second structure, again, the cost of distress only has impact on debt value. So only the value of debt would be changed. The value of equity would not be changed. So here we got, if we look at the value of debt, in case of success, the debt holder will receive $150 million. And in case of success, the debt holder receive the whole $150 million. But in case of fail, the company receive $100 million, and $100 million go to the debt holders. However, with the cost of interest, they have to pay $50 million cost of interest. So only $50 million would go to the debt value. So that's why I marked this number in the red colors. So this is where the cost of interest affect the value, the firm value. See that? So the debt value here is only $96.2 million. And then the value equity would remain the same because cost of interest doesn't have any effect on equity. So the value of equity is still $72.1 million. And then the value of the firm is debt value plus equity value. We got $168.30 million. And of course, this number is different from the firm value in the first structure. So we see that the first structure and the second structure use different value of firm. That means the MM proposition does not hold in this case. You see that? So in case of financial distress or bankruptcy, the MM proposition one doesn't hold. And one question, who pays for the cost of financial distress? Who pays for that? And the answer is the original shareholders. Alright. Now let's consider the trade-off theory. In the perfect world where there is no cost of financial distress, the levered value of the firm is equal to the unlevered value of the firm plus the present value of interest tax shield. In reality, when there are costs of financial distress, the levered value of the firm is equal to unlevered value of the firm plus present value of interest tax shield, subtract the present value of the cost of financial distress. And the second equation is called the trade-off theory equation. And in this topic, in this trade-off theory, we have to answer two interest questions. The first question, what are the factors affecting the present value of the financial distress cost in this equation? And the second question is, what is the optimal lever implied to the trade-off theory? So let's go over one by one. First, the present value of financial distress cost. The present value of financial distress cost is determined by the following three factors. First, the probability of financial distress. The probability of financial distress increases if the amount of liability with the amount of liabilities relative to the amount of assets. The probability of financial distress increases with the volatility of cash flows and asset value. The second factor is the magnitude of the cost if the firm is in distress. Firms that depend heavily on human capital are highly likely to have high costs of financial distress, and usually these are indirect costs. Human capital here could be either employees, like can be either employees or customers. The firms whose main assets or capital structures are likely to have lower cost of financial distress, for example, like real estate, like something that the firm can sell quickly for money. They would have lower cost of financial distress. again, the human capital here may be either customer or employees, any kind of human capitals. The second type firm is like capital structure, like real estate or kind of properties that the firm can sell quickly for money. The last factors that affect the present value of the financial distress cost is the appropriate discount rate for the distress cost. Usually higher beta would have higher distress cost because high beta means higher risk, right? And higher risk means higher distress cost. And the second question is about optimal leverage. Here on this diagram, if you look at this diagram, the vertical asymptote is the value of level firm VL. The horizontal asymptote is the value of debt, which is D. You see that? And this slant line is the unlevel value of the firm. You see that? When there's no value of debt, the unlevel of the firm is exactly the level of the firm. So that's why this line crossed the vertical asymptotes at VU. You see, let me repeat. In case of no debt value, that means when the value of debt is 0, this line cross the vertical asymptote at VU. That means the unlevel firm value should be the same with the level firm value. There's no tax shield, there's no interest tax shield, there's no because no debt means no interest, no tax. So unlevel firm value should be equal to level firm value. All right. And then you see that when the value of the debt increases, the value of unlevel increases. You see, increases. See that? You see that the trade dotted line represent the present value of the interest tax shield tau C times D, where tau C is the right here. Tau C is the corporate tax rate, and D is the value of debt. You see that? When there's no debt, this line crosses the vertical asymptote right at VU. That means unlevel firm value is equal to level firm value. Of course, the gradient of this line is tau C. That is the corporate tax rate. And the vertical intercept of this line VU, you see that means when there's no debt, unlevel value of firm is exactly the level value of the firm. For a level firm that is subject to no distress cost, its value would continue to rise linearly until the tax shield is exhausted. You see that? Is raised linearly. You see that's why it's a trade line, right? It's raised linearly when there's no distress cost. When there's no distress cost, the line should go linearly in the in the dashed line. You see that? Now for a level firm that has distress cost, that means in case of distress, we see that there is a trade-off between the present value of the interest tax shield and the present value of the financial distress cost. You see that the first line here, you see again, let me repeat this. When there's no debt, the unleveled firm value is equal to the level firm value. When there is debt but no distress cost, you see that the unleveled value of the firm, the level value of the firm is like almost rising linearly. You see, almost like trade line. When we have low distress cost, this is the line when we have low distress cost, and when we have high distress cost, we have really low value of level firm. You see that? So there are a couple summaries here. At the beginning, when the debt level is low, the probability of default is low, so the present value of financial distress cost is the same. Hence, the increase of present value dominate and the firm value increases with D. However, both probability of default and present value of financial distress cost increase as the debt level rises. You see that? When the debt level becomes sufficiently high, the increase of present value interest tax shield is exactly offset by the increase of present value financial distress cost. At this debt level, which is denoted by D star, you see D star, the firm value is maximized. See that? When the debt level rises further, the increase in present value financial distress cost is larger than the increase in present value interest tax shield. So a further increase in debt level would reduce the value of the firm. You see that? So that is about optimal leverage. So for this trade-off problem, you see there are two types: present value of financial distress cost, and present value interest tax shield. Why is it called trade-off problem? Because present value of the interest tax shield is beneficial for the firm, but the present value of the cost of distress of financial distress is a burden to the firm. So that's why we have to, try to balance these two factors in order to have the best benefits. So to understand optimal leverage better, let's go over example 4, and this is the last example in this lesson. Consider the following estimates in millions of a present value of interest tax shield and present value financial distress cost of a firm. Here, this firm considered to borrow money, maybe no debt. That means they use totally equity, or they can borrow $5 million or $10 million, $15 million, or $20 million. And the question is like, which amount of debt is the best choice to optimize this project? So we got a table here. In case the debt value is 0, of course the present value interest tax shield is 0, and the present value of the financial distress cost is also 0, so no debt, no problem. In case of $5 million debt, the present value interest tax shield is about $1 million. The present value financial distress cost is about $0.1 million. In case of $10 million debt, the present value interest tax shield is 1.5, present value financial distress cost is 0.4, and so on for the other two cases. So question, what is the optimal debt choice for the firm? So in order to answer this question, remember that the lever firm value is equal to unlevered firm value plus present value interest tax shield subtract present value financial distress cost. Here we have to consider these two present value. So what we have to do is we take present value of interest tax shield subtract present value financial distress cost to see which one will have a better numbers. So let's do this. Do the subtraction. 0 subtract 0 is just 0. 1 subtract 0.1 is 0.9. 1.5 subtract 0.4 is 1.1. 2 subtract 1 is 1. 2.5 subtract 1.9 is 0.6. So you see that when you borrow $10 million, the biggest gap is 1.1. So this is the best number, right? It would give higher lever firm values. So the optimal debt choice should be $10 million. This is the best choice. Hence, the optimal debt choice should be $10 million. Alright, so that is it for this lesson. Thanks so much for watching my video. I hope you guys enjoyed my video, and see you on the next video. Bye bye.